Have you considered a joint venture to help you get into property or get to the next level? That's what we're going to discuss in the show today, together with how the Reserve Bank sets interest rates, maybe you've wondered, and Ken Race answers a listener's question about depreciation.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
Welcome to this week's show. I've got lots to discuss, whether you're a beginner or an experienced investor. In particular, we have a chat about joint ventures, the pros, the cons, should you, shouldn't you? Because many people are having difficulty getting into the property market. Others are having difficulty getting to the next level. Some are considering joint ventures to get involved in property development. I discuss all those things. In fact, I started my property journey with a joint venture with my parents. I'll explain all that to you in just a moment. We're also going to have a chat with Stuart Wemyss from Pro Solutions Private Clients about how the Reserve Bank sets interest rates. Have you ever wondered what they do each month when they have their meeting and how it affects us, and then what the banks do about it? We're going to discuss that too. And then Ken Race answers a listener's question about depreciation, which may just be relevant to you. Lots to discuss, but now let's get on with the show. Have you ever considered going into a joint venture to help you get into property investment or to get you to the next level? I know that's how I got started. And today, with the difficult finance climate, it's not uncommon for a group of people to want to pool their resources in order to increase their buying power. And others are doing it because they see it spreading their risks. While it's not necessarily a bad idea, it's really wise to know what you're going to let yourself in for and how it all works. So I want to dig into this a bit deeper because only last week I saw somebody who was trying to extract himself from a joint venture. He and a group of mates about 8-10 years ago bought some properties together, and the properties have done reasonably well. Well, 2 out of the 3 did, but now he's trying to get himself out of that partnership, and while he wants to, the others are not so keen. So it's created problems. So if you're considering going into a joint venture with a family member or a friend, let's maybe look at what you should consider. First of all, I guess the first question I ask is it worth it? In my opinion, family is much more important than money. And like it or not, when money comes into the equation, relationships sometimes change. So if you haven't had a long-standing, healthy relationship with the family member or a friend, don't proceed. If your relationship's had a tattered past, which hasn't fully healed, don't think that a successful property deal is going to heal all wounds. It won't. But then if you decide, okay, I am going to go ahead, I am going to proceed, put it all in writing before you set sail. Every role, every expectation needs to be clearly defined and documented. I'd be writing down things like your goals. How many properties are you planning to buy? What's the aim? The responsibilities. Who's going to liaise with the banks? Who's going to liaise with the property manager, the estate agents? Who's going to do the negotiation? Definitely got to write down the financial contributions, how much each partner's contributing. You also should write down what each cut of the profits each partner's going to take, or how, or you're going to leave it in the kitty, or what about the negative gearing, if that's what's going to happen, who's going to and how you're going to contribute to that. What time frame are you going to put upon your portfolio? How long are you going to hold it? What's the intention? What are your borrowing obligations? What are your legal obligations? What are your tax obligations? You've got to think through all those, write them down, document them, and make sure you agree. Now, before you get involved with friends in particular, but also family, you really got to be confident in their ability to take on a financial commitment. You may be confident with your finance capability, but what about your friends? Have you had an honest conversation with them about their financial or their employment situation? Because once you start borrowing together, things get a bit hairy. See, you could get together and each put in $100,000 to kickstart your portfolio. But where's the money going to come from? Do you have cash, or are they going to borrow? They're going to borrow against their home. Don't cross-collateralise the homes. Do it all separately. Then there's the more concerning issue that if you do take a loan together, you're jointly and severally liable. That means that if one of them leaves the country, the bank's going to chase you up for the debt. You're liable for the whole lot, not just your third. Now, it gets worse. It actually lowers your credit position. See, while the bank may recognise that you've got a third ownership and you will get a third of the income, it puts down a third of your income, it still sees you liable for the whole of the mortgage. So when you look at your serviceability in the future, they're only going to give you a third of the income, but take on the whole of the debt. This, of course, is going to restrict your borrowing power considerably. But the next question, and this really came up as I was speaking to our client last week, was what if you decide to take a different path? You know, you've successfully grown a portfolio with two buddies, your friends are content to sit on them indefinitely. However, you feel a third share of a property portfolio isn't what you want. It's not going to give you the retirement nest egg you want. So what do? Unless all three parties have agreed, you may not be able to borrow against those properties to buy another one yourself, separately or together. You're now going to have to decide, are you going to exit the partnership? What if you do that? What about the capital gains tax and the other issues with it? Are you going to start all over from scratch again? So the bottom line is you're tying your future to that of your friends or family that you're investing with. But if that does happen, who's going to decide the exit plan? Often you start off as a group of single, cashed-up friends wanting to get into a venture, move forward. But what happens when you're no longer single? What happens when you find that one person, the special person, and decide, I don't know, you may go move to the country or start a family, or you need the money to buy your own family home, or there's that unpleasant thought of divorce that may require you to liquidate your assets. You're going to need money from your portfolio, but what if your friends refuse to sell? Now, these are the type of sticky situations that they're not out of the question and could cause not just a friendship breakdown, but a tricky and costly legal battle. That's again the reason you've got to document your entry and your exit strategy and how it works. Now, you can also protect yourselves a bit by insuring yourself. Life insurance and income protection insurance is a critical part of a joint venture agreement, just in case the unforeseen arises. Rainy days can happen, so you may as well own an umbrella. But having said all those negatives, let me just finish off by saying never say never. While there are obvious pitfalls to consider if you plan to invest with friends or family, don't rule it out. I got into the property market in the 1970s because I partnered with my parents. In the 80s and 90s, I managed to take part in some very, very significant property developments by choosing the right joint venture partners. And now I'm in the position to help my children get into property by partnering with them. So don't rule out joint ventures. Just look at them very, very carefully. I see we're coming up to our short break, but I'll be back in a moment with Stuart Wemyss to discuss how the Reserve Bank sets interest rates. And it's actually not a boring topic. When you get into it, you'll find lots of interesting things that may well affect you. And Ken Race is going to discuss a listener's question about depreciation. And the rules changed, so let's understand what they're all about.
If you're looking to get started in property or to grow your existing portfolio, turn to someone you can trust for independent advice. The team at Metropole Property Strategists have been involved in over $2 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. They don't sell property, so their advice is independent and unbiased. Metropole can devise a strategy, their buyer's agents will buy your property for you, or you could use their renovations team, property development or portfolio management services. Arrange a time for an obligation-free chat at metropole.com.au.
Each month, the Reserve Bank sets interest rates. We wait to see what the announcement is. As property investors, we wonder, what should we do with our interest rates? Should we lock in? Should we borrow more? And so today I'd like to have a chat with an expert about how the Reserve Bank sets interest rates, how the bank sets interest rates, and what we as property investors should understand about all this. So my guest today is Stuart Wemyss, Director of Pro Solutions Private Clients. Welcome, Stuart.
Thank you, Michael. Great to join you.
And Stuart, we've started to chat privately about how the Reserve Bank sets interest rates each month. So maybe we could have a bit of a background information. What's the Reserve Bank's role?
The Reserve Bank is independent from the government, and its main role is to manage inflation and also manage Australia's exchange rate. So inflation is managed through really money supply. So the interest rate is really the price of money. So if you want to increase the flow of anything in the economy, you reduce the price, so you reduce the interest rate. If there's too much money in the economy, it's growing too quickly and it's creating too much inflation, well, you just increase the price of money and therefore it becomes more expensive and people can afford to use less of it. Also, the interest rate that you can get on deposit here in Australia will affect the exchange rate as well. So if rates are very low in the US, for example, or around the world, and interest rates are very high in Australia, then obviously foreigners are going to want to take and deposit their money here in Australia. So the Aussie dollar becomes more popular, the exchange rate increases compared to the US. So interest rate's another way to sort of play with, although it's a bit of a blunt instrument, as they've seen, because I'm sure the RBA would like the exchange rate under 70 cents for the economy-wise, and over the last number of years it's been obviously higher than that.
Well, the Reserve Bank is currently giving us what they call stimulatory interest rates. In other words, rates are below what they call neutral. If rates go too high, they actually depress the economy, they slow inflation down, they stop us spending. But currently interest rates are on the low side to encourage businesses to invest in equipment, to employ people, and to encourage consumers to spend. And so there is the suggestion that in due course interest rates are going to go up. But currently the Reserve Bank is trying to stimulate the economy, but it's not having as much success as it would like, Stuart.
No, it's not, and it's the absence of inflation. The RBA is really waiting for inflation to pick up. And until inflation picks up, I doubt that they're going to increase interest rates. Now, the absence of inflation is not an Australian issue. It's a global issue. And whilst there's been a lot of analysis, I've done a lot of reading about it, been to a lot of presentations, the answer is no one really knows why. Why are the economies growing? Because the US economy is doing well, Europe is recovering, the Australian economy underlying is doing quite well, but there's an absence of inflation. Now, there's been lots of things about whether it's a change in demographics, is it because of low wage inflation and these sorts of things, but no one really knows. So until inflation picks up, I doubt the RBA is going to make any sort of movements, but that's exactly what they're just going to change the price of money to try and keep the economy balanced.
And this is interesting because there's going to be a generation of listeners to this who are thinking, what are these old guys even talking about? Inflation has always been this way. But the answer is it hasn't. You and I are old enough to remember when if interest rates for your home loan were less than 10%, you were really happy.
Yeah, that's right. But it's a completely different economy today. The amount of borrowings that domestically that we have is a lot higher, so we're a lot more sensitive to interest rates, and we have a floating exchange rate now as well, where we had a managed exchange rate back in the early 90s when interest rates were very high. So, you know, when I talk to clients about what's worst case scenario, and they say, "Oh, I remember I was paying 18%." Yeah, you sure were, but not for a very long period of time. It was about sort of 9-month period when interest rates are high. I'm sure that
I remember those days well, Stuart. Yeah,
I'm sure it hurt.
Yes.
But I can't see interest rates getting up to that level. I mean, certainly I might go to 7, 8, maybe even over 8% at times if the economy gets really heated, but I doubt we'll ever get back to sort of double-digit interest
Well,
rates.
before people get too scared, Stuart, the reason interest rates are going to go up is because the economy is going to be strong, wages growth is going to be there, property values are going to go up, so the Reserve Bank's going to raise interest rates to slow us down. So don't get scared, because if you're a property investor, a business owner, you're probably going to be in a really good position, but you're going to have to understand that the cycle will move on. So how does the Reserve Bank decide what interest rate it's going to charge?
So the cash rate, which is what you'll see in the media and what the RBA meet about the first Tuesday of every month, except for January, is the rate at which banks lend to each other on an overnight basis. So essentially what they're trying to do there is change the bank's cost of funds. And so they increase the price of money for the banks, and therefore they know the banks are going to pass that on. And that's the way that they sort of stimulate. The things that they consider are mainly inflation. They've got to keep it between 2 and 3%. So if it's below 2, they want to reduce the price of money. If it's above 3, they want to increase the price of money. And then obviously there's a lot of macroeconomic indicators that they consider. But inflation's a main concern.
So why do the banks charge me 4 and 5%, Stuart?
So you've got to, and this is a really important thing to understand, how a bank funds their mortgages. So you go to the bank and you go borrow $500,000, but where does the bank get $500,000? Well, there's a couple of different sources. Obviously, they get it from deposits. So if you've got self-managed super funds or wealthy individuals, they're putting money on deposit with banks. That's going to be a portion of how they fund it. There's a thing called securitization, which means that they package mortgages up and then sell them to investors. That's a way that they fund. And then they use short and longer term debt. So they sell bonds to the market. Now, depending on how they fund their mortgages will depend on how impacted they are by the RBA's movements, and also depending on the pressures from the government. So the government, since the GFC, has forced the banks to fund more through deposits, because obviously that makes it for a stronger financial industry, and it means banks are stronger rather than using off-balance sheet methods. So small lenders, during the GFC, the larger lenders and credit unions who had large deposits really were able to weather the storm much better. In today's environment, because there's a lot of pressure on deposits, it's a very competitive environment, and interest rates are low, so even just a small difference in interest rates makes a big difference. So securitized lenders, so small mortgage managers, for example, have more ability to compete on price with banks. So it's a complex area, Michael, but it's really about sort of understanding at a higher level how it works, and then it gives you an idea of how the competition in the mortgage market actually impacts the end.
So why do the banks charge property investors more than they charge owner-occupiers, Stuart?
Mainly because the government has forced them to cool the property market, because they don't want people speculating in the property market. And I think it's a bit of a misnomer, because people can speculate in the share market because it's a very liquid market, and the transactional costs are very low. So I can take a view on a particular stock and go buy some Myer shares because I think they're undervalued. And if I'm wrong, I can sell them, and I don't have much to lose. In the property market, we've got to pay stamp duty and selling costs and so forth. So it doesn't really attract speculators. But in any case, the government didn't want people to speculate in the property market while interest rates are really low. So they forced the banks to increase or reduce the amount of investment lending that they're making. And the way to reduce volume is to obviously increase price.
Well, I think they've done it in a good way. Every other property cycle I've been involved in has ended because of high property prices. This cycle has been slowed down through the old-fashioned credit squeeze, where we're still in a lowish interest rate environment. So those who've got a mortgage aren't in trouble. Businesses still are borrowing at reasonably low costs to encourage them. So I think the guys at the Reserve Bank and APRA have done a pretty good job this time around.
We don't want a price bubble. So I agree with you, Michael. And really, interest rates are still low. Sure, they're charging a little bit more for investor loans, but if you compare the interest rates, say, at 5%, maybe, it's not that big a deal. I mean, it still works as an investment.
Now, I know you're in a pretty unique situation, because not only are you a mortgage broker, but you are an accountant by degree and a financial planner. So when you sit down with a client to understand which lender you're going to choose for them, how important are interest rates?
If the client, depends on the client stage, investment stage. So if they're at the acquisition stage, so they're still acquiring assets. If they've got one investment property but they know they need to acquire 3, then I would argue that interest rate is not very important. Access to funds so that we can implement the plan is far more important than an interest rate is. If they're at the latter part of their journey, so they've acquired the assets that they need to hold, and they think that they probably don't need much more access to more borrowings, more funds, and I'd caution people to really draw big conclusions there, then interest rate starts to become more important. So managing borrowable equity and the ability to safely go out and borrow and manage your risks is far more important than, even a 0.5% difference in interest rates.
Took me many years of my property investing career to realise that real estate investing is really a game of finance with properties thrown in the middle. So you've got to have a finance strategy, you've got to have financial buffers, and interest rates are, in my mind, only a really small part of the finance strategy. You've got to have flexibility, and you've really got to be able to see through the property cycles and not get caught out.
Take a long-term view. The best financial decisions are long-dated financial decisions, but taking a long-term view reduces the anxiety created about worrying about short-term market movements or short-term interest rate cycles. Don't worry about it. Make sure it's affordable today. Make sure it's affordable at higher interest rates. Invest in good quality assets and take a long-term view. You want to be better off in 10 or 20 years. How your financial position change over the next 1 or 2 years is really inconsequential.
That makes a lot of sense. Stuart Wemyss from Pro Solutions for Private Clients, thank you very much for your time.
Thank you very much, Michael.
I love receiving your questions, and today I've asked Ken Race, my business partner in Metropole Wealth Advisory, to join us to answer a question about depreciation. Welcome, Ken.
Hi, Michael.
Now, I've got a question here from Jonathan from McKinnon in Victoria who asks, can you still claim depreciation on the purchase of an established property? I know a lot of people are wondering about that.
Yeah, great question. There's 2 types of depreciation on a property, on the building and on the fixtures and fittings. So on the building, you can still continue to claim that depreciation. But from the recent federal budget, they've stopped now the ability to claim depreciation on the fixtures and fittings. But if you do a renovation, you can then claim that depreciation on the new costs that you have spent on refurbishing and upgrading your property.
Now, let's be clear, Ken, this is, of course, for a new purchase. If you've already purchased a property before budget night, the answer is all that still remains.
All that still remains, so nothing changes. So it's only if you buy an established property from the date of the budget. If you buy a new property from the date of the budget, then you can claim both depreciation types, which is the building and the fixtures and fittings, which is, the carpet, the hot water system, the curtains, all those sorts of things. So you've got to distinguish between the 2.
And if you're not sure, you can always speak to one of the depreciation consultants who can give you an overview of how much depreciation is involved. And again, it's like the other nice tax benefits of owning property in my mind, Ken. It's the cream on the cake. It's not the reason not to buy an established property, because usually you're paying a premium to buy new properties. You're paying the developer's margin and the marketing costs and then the big brochures and that. So I guess it's all got to be taken into the big picture.
Correct. And the other big thing to look at when you're looking at depreciation is if you've got multiple owners on the title, you need a different type of depreciation schedule. A lot of people are missing out on benefits that they otherwise could have got because of incorrectly setting up the depreciation schedule. So with 2 people claiming their separate components, you accelerate the time that you can claim the depreciation, which means you get the benefits faster and sooner.
Great. Well, thanks for answering John's question. Look forward to having you on our podcast again real soon, Ken.
No, thank you very much there, Michael.
Well, there you have it. Thanks for listening to this week's show. We discussed a lot, didn't we? We discussed a bit about joint ventures. Stuart Wemyss taught us a bit about the Reserve Bank and interest rates, and Ken answered that listener's question. I hope you got something from it, and if you did, please do me a favour, pass the message on, tell somebody about it through Twitter, Facebook, send them an email, or just write a review. Go to Michael Yardney podcast/review, and that will inspire me to keep giving you this great content. I look forward to being in your ears again next week.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes, where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 20 minutes.